Hey everyone, in this video I wanted to highlight how Blink Charging is making huge strides towards profitability. Now keep in mind it's still got a long way to go. The company's still losing a lot of money on the bottom line, but it's making progress. It's taking big steps forward. So let's take a look at just how it's doing that. Starting with the top line with sales. So product sales in the first quarter were 16.4 million. That was an increase of 104% as customers are purchasing greater volumes of its commercial chargers, its DC fast chargers, and residential chargers. Also in the first quarter, service revenue, which consists of its charging service revenue, network fees, and ride-sharing revenues. That might be surprising to some of you that Blink Charging has just acquired a ride-sharing company and it's providing ride shares and it's earning revenue from that small segment of its business. Overall service revenues was 4.8 million, an increase of 216% compared to last year. So the service segment growing faster than the product segment. Moving on, so for the first quarter of 2023, gross profit came in at 4.5 million. That was an increase of 186% compared to the same period last year, and the gross profit margin of 21% was about 4,800 basis points better than the same quarter the prior year. This is great news, right? And this is the big step forward that I was talking about in the start of the video about its profit. So as the company is growing its sales, it's expanding its gross profit margins. It's utilizing more of its capacity and spreading out its fixed cost across greater number of sales, and that's delivering growth in gross profit. So that's just the first step of profitability is gross profit margins, but it's nice to see the company making excellent progress on that front. Furthermore, so of course, the bottom line, like I mentioned, is still not good. The company generated a loss of 49 cents per share in the quarter adjusted. That was more than the 34 cents loss per share in the prior year. So the bottom line worsened in the most recent quarter. However, there is some good things to note here. The company saw a decrease in gross profit margin compared to the fourth quarter of 22. That was primarily due to selling more contract manufactured chargers, which carry a lower overall contribution profit margin compared to units manufactured in-house. So that's a big thing there. So companies sometimes use third-party manufacturers to produce units, and that provides a bit of diversification, a bit of lower risk for companies because with third party manufacturing, you can scale up or down depending on sales. But with in house manufacturing, you don't have the luxury to scale down when sales decrease. You still have those fixed expenses. So it's riskier. However, it provides higher gross profit margins when you're producing in house. So Blink Charging now feels comfortable in its growth, in its prospects to bring more manufacturing in-house. So as they discussed, they've been expanding their manufacturing capabilities to replace all contract manufactured chargers with in-house produced units. So when this is completed, when they're no longer contracting any of their chargers, that's going to boost gross profits further. However, that will come at a cost, and the cost is a greater degree of risk and, of course, the cash needed to build out that in-house manufacturing. That's not an easy thing for Blink Charging, which has been constrained in cash, and now the rising costs of borrowing, the rising cost of capital will make it even harder. So, however, when they do this, it'll increase the gross profit margin profile of their products, but they only have 103 million in cash as of its latest update on March 31st. So, they're constrained on cash. They're likely going to need to tap capital markets either by issuing more stock, which is going to dilute shareholders, or by going out and borrowing the funds, which is pretty costly now since the Federal Reserve has increased interest rates by more than 500 basis points in the last year. So, a bit of a situation here where, yes, Blink Charging has the opportunity to improve profit margins by bringing manufacturing in-house, but at the same time it's going to cost it capital, which is also very expensive, so they need to have a nice balancing act between those two factors. But overall, they're making very nice progress towards profitability. Still a long way to go, but it's a good sign that they're making and taking big steps forward. But that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.